There's no indication that the multi-stage DCF model is biasing the results. As I talked about earlier, it's frustrating. You can never actually look backwards to determine how well a model predicts the cost of equity. But for the multi-stage DCF model, the key input does reveal itself. That's the total cash flows that Dr. Vladson showed you. So what we can do is we can look back and say, if Western Coal Traffic League is right, the board's model should be predicting total cash flows that are well in excess of what were actually realized. And when we do that, we actually can empirically test whether or not there's a disconnect in the key input in the multi-stage DCF model. And when we do that, it shows that Western Coal Traffic League was wrong, and not just a little wrong, they were significantly wrong. But Western Coal Traffic League clearly disagrees with the position the AAR is taking, but I would note that their members, as they predicted that I was going to say, their members take different positions before their state regulators. We submitted a testimony in November about how they were extolling the virtues of multi-stage DCF, about how they're warning against relying on a single model, and how they advocated market risk premium well above 5%. Well, since November, we thought we'd canvass the literature to see have they made any such statements more recently in 2015. And lo and behold, they have. So what are they telling their own regulators about using multiple models? Kansas City Power and Light is telling their regulator it's prudent and appropriate to use multiple models in order to mitigate the effects associated with any single model. Or you can look at Kansas City Power and Light. It's essential to employ a variety of techniques. Or we can look at Entergy, who says that no single approach can be relied upon as wholly reliable. Now, Western Coal Traffic League says, well, maybe the markets there are different. Maybe somehow the utilities are a little bit different than the railroads, and we can take inconsistent positions. But what are they telling their regulators about the market risk premium? Here, there is no plausible argument that the market risk premium should be different for utilities than it is for the railroads. It's the market risk premium. It's the market risk premium for the whole market. Well, what are they recently telling them? Well, that just 2 months ago, Kansas City Power and Light was advocating a future forward-looking market risk premium of 10%. Wisconsin Public Service just 2 months ago in 7 or 8%. Entergy 9%. Mid-America 7%. Ameren 9%. Yet Western Coal Traffic League is telling you that the market risk premium in the current environment cannot possibly exceed 4.7%. Now, ultimately, the board will have to judge the credibility of the witnesses that come before you, but the AR submits that the credibility of Western Coal Traffic League is severely undermined by its own members. We would submit they speak the truth to their own regulators while asking you to set aside best practices in the hopes of driving down the cost of equity. With that, we would be pleased to answer any of your questions.
I just had one quick question that was related to a question that I asked earlier and that I think that you touched on in your testimony about increasing the number of railroads. And my question before to Western Coal Traffic League regarded the Canadian railroads and adding them into the mix, and if that would be helpful or not. And also, I think this would be more to Mr. Atkins, whether our present regulations would permit that.
I'll ask Dr. Vladson first to talk about about the need, and then I'll speak to the legality.
Well, first, I will note that we do have the majority of the freight volume and the majority of the revenues, which is a key point to me. You must have the majority of the industry. Second, there's a problematic issue with the Canadian railroads, and I have not studied them in enough detail lately to be fully coherent on this. But they face a different kind of regulation, and that might be problematic in that they might not be completely comparable, so we might have to make some adjustments if we were to include those. So I would say at this environment, we currently have the majority of the freight volume, so that probably is reasonable approach at this environment.
And I think the AR's position would be it would be a mistake both on a matter of policy and law to be including the Canadian side of it. You're trying to determine the risk profile of the American railroad network. And so including the the risk profile of the Mexican railroads is different than the risk profile of the American railroads. The risk profiles of the Canadian railroads is different. They live in different environments. They face different financial considerations. They have different marketplaces. And so to import the cost of equity from Canada or Mexico, or you could look in Europe at railroads overseas, We feel that there's no need to expand the portfolio of railroads that you look at to include the Canadians. And as Dr. Blatson notes, we don't think it actually would have a material outcome on the estimates, even if you were to travel down that path.
Wouldn't it be possible, though, to look at the Canadian railroads just in terms of their U.S. operations? I mean, they say they operate separately in the U.S. from Canada. They file taxes in both countries and separate out their operations. So why is it not possible to look? We look at KCS in this country, but not in Mexico.
Unfortunately, what we do when we estimate the cost of equity, we look at the market data. So we need to have something that's traded, like the stock price is a trading issue. And the Canadian railroads have only one stock that trades. They don't have one in each country, so we can't do that.
So it's a very good question. If they were separately trading the American portion of it and it has separate stock price, then we could easily add them into the group. But they don't. It gets woven into a single stock price for the whole company.
Could you say a bit more about why you're not concerned about the small number of railroads? And let me play this back and be sure I'm getting it correctly. You're saying that even without BNSF, relying on the other 3-4 railroads, you have the majority of freight movement and the majority of revenue or cost. I can't remember how you were stating. Is that correct, even when you take BNSF out?
That's correct. So you have the majority of the industry, even when you take BNSF out.
It's an awfully big player to take out, though, don't you think?
Yeah,
and you know, one of the things WCTL said, and you know, maybe this is just a snapshot in time, and maybe in some ways it doesn't go into this calculation, but BNSF accounted for something like 43% of the capital investment in railroads. I mean, that's almost 50% of the capital investment is coming from the one railroad we're not even counting. And excuse me, and I really will give you a chance to answer. And then on top of that, I think, you know, one of the concerns isn't just without BNSF in it, can we move forward, but what would happen if we lost another railroad, which is certainly not like a crazy scenario that's likely to never happen. It's a reasonable concern and a reasonable scenario.
So let me address first the capital expenditures. It is true that BNSF has accounted for the majority of that, which probably, if anything, will lead us to have an underestimation of the MSDCF numbers because they've had a higher growth relative to the other railroads. So we have taken that out. We've also taken it out of the capital asset pricing model. For most of these purposes, my real concern is to make sure I have enough of the industry. I want to have the majority of the industry. That's my number one concern. If you ask me as a statistician, I would love to have had 20 railroads to do my estimation on. That's not going to happen. So my concern then becomes, what is the best alternative? And my alternative currently is to go to some very small line haul railroads, go to the Canadian railroads, or go to Mexican railroads. That's my alternative currently, because I do need a company that is publicly traded to actually do any estimation on it. And I'm not sure that the Canadian railroads regulation, or even worse, the Mexican railroad regulation is such that you actually can compare it to the U.S. railroad industry. And if you look specifically at the Canadian railroads, it wouldn't make much of a change actually in the beta estimates. Their betas are very close to that of the U.S. Their growth rates are actually slightly higher.
So say more about why you reject the idea of the S&P 500. I mean, I appreciate it's a broad index of the market, and railroads are very capital intensive, and everything in S&P 500 isn't capital intensive, but it certainly seems that there are other elements of it that would make excellent sense.
We have to remember here that what we really are trying to estimate is what is the inherent risk in the assets we are regulating, or the assets we're trying to estimate our cost of capital for. So if I'm looking at the S&P 500, I'm seeing an awful lot of financial institutions who I would consider to be very, very different from the railroads. If you were to look at some other industries, you would try to look for some industries that were comparable to railroads in some sense. You would look for capital-intensive industries, industries with high volatility in their revenues, industries that have similar features to the railroads. That would be what we would be looking for, not for broad
revenue. Railroads have a high volatility in their revenues?
They have had a high volatility.
Over what period of time?
If you look back to the financial crisis. And they
Well,
have-
everybody had a high volatility during the financial crisis, didn't they? Well, I'm sure not everybody, but broadly across the market, there was high volatility.
And the number one thing, if you look at the capital asset pricing model, you will look to is also the volatility in the returns to investors. That of the railroad was quite a bit higher than the market in general. And it was extreme if you look at some of the financial institutions. And I don't think neither the ones who had no volatility, neither the financial institutions who saw volatility of extreme amounts would be representative for the railroads. So if I were to do something differently, I would look for companies that had characteristics similar to the railroads, not for a broad slew of the S&P 500.
In WCTL's testimony, one of their areas of emphasis was that CAPM is broadly used by players in the market, not DCF models. You really didn't address that. Do you disagree with that? I mean, the impression given was that, by and large, most businesses, I guess is what I should say, who utilize one of the models are going to go to the CAPM.
I don't disagree that if you go and ask businesses, what model do you estimate, they will say the capital asset pricing model by far the most frequently. I also work with a lot of businesses, and what they do is they make adjustments to the capital asset pricing model, especially during the most recent period of time when they don't think it actually fits what they call their hurdle rate, at which rate would they invest. If they come up with a number that's too low, they will subjectively adjust it to fit something they mean. Another interesting point I want to make on that is that it is true that very few companies go out and estimate the discounted cash flow or any version of that to make specific investment decisions. However, if you look at a textbook as Berg and DeMarso, which is a fairly common financial textbook, they show you that, yes, most companies estimate the capital asset pricing model, and then most companies look to other factors, whatever that might be.
So one of the other things WCTL suggested this morning in their testimony is that we might want to think about some benchmarking. What do you think about that?
A lot of that would depend on exactly how you implement that. That is a case where it would all be in the details. So until we have a concrete proposal, and I don't think the WCTL has brought one forward, I don't think I have specific comments on that. I'm not in principle opposed to benchmarking. It depends on how we implement it.
And Commissioner Miller, two additional points. One is, when I mentioned the FCC report that went out and canvassed the literature, they came back and what they found was that, yes, CAPM is the most widely used model in the business community, but the multi-stage DCF model is the most widely used model by regulators. And they came to the conclusion that using a balance of the two of them is preferable to using either one. And I think that a little bit of the reason is the multi-stage. You couldn't just subjectively adjust the CAPM model if you thought it wasn't quite forward-looking enough. You'd have to explain that subjective modification. But if you take a model that's based largely on historical information like CAPM and weave in a multi-stage DCF model, you're going to get a range and use an average of the two as being rather reasonable. Second point I'd like to emphasize is, I think it's a broader question of what standard should this board impose on Western Coal Traffic League or the AAR or even its own staff in terms of when you're going to tinker with the approach that you currently use. Because the one lesson that everybody learned from those prior rulemakings was there's just a huge variety of models and a huge variety of inputs that can go into those models. So if we don't have a compelling standard, and historically you've actually held all the parties to a high bar. You said, show me compelling evidence that what we're doing is flawed. If you don't have that high bar, then we're going to have two problems. We're going to be here every couple of years with this debate, which I don't think is in the board's interest and it's not in our interest. Plus also, you interject into the community unnecessary uncertainty, which I don't think is in the interest of the community. Some stability in the estimate, I think, is appropriate. Now, take as an illustration, if we lost UP, if UP became a private company and we could no longer perform our approach, we've lost the whole western side, that might be enough to trigger a need to re-examine, how do we have to change the model. But I know we lost BNSF, but it wasn't the majority of the industry, and the AR feels that you can continue to use the two approaches that you've got.
And then could you say a little more about, see now I'm not going to get it right again, VisiCheck? Why you've recommended that? I mean, even with my butchering of the pronunciation, still I got such a blank stare from the finance professor that it makes me wonder how common this adjustment is over the Bloom adjustment.
The VisiCheck, and I think that's the right pronunciation.
I'm sure you're saying it correctly.
The reason that I think that's a better adjustment is that it is based on sound to a statistical analysis of what is the precision with which you estimate your beta for the railroad industry, or with which you estimate precision of any other beta you try to adjust it towards. I like that approach rather than sort of saying 2/3, 1/3, and that's based on data that was estimated from 1926 to 1960, and I'm not sure it still holds. In terms of how useful it is, there's not a whole lot of North American regulators who have used it. It's fairly commonly used in Europe. It's used by the Dutch regulator. It's used by the Italian regulator. It has until recently been used by the Spanish regulator, and unfortunately I was unable to read Spanish enough to figure out what they actually did in the most recent decision.
And another point to make about is my understanding of beta, and Dr. Vlatson hopefully will interject if I'm wrong, is it all comes around concerns that your estimate of the beta isn't sufficiently accurate. So there's uncertainty in your estimate of the beta, and so they believe that if you're going to estimate the beta and then you're actually going to use it to set rates for like the next 5 years going out, you might need to put in this adjustment to bring it down towards 1, because that's what you might think would happen. The more solid you are about your estimate of beta, the less you need to do some sort of arbitrary 1/3, 2/3 adjustment. But also, importantly, the more frequently you're calculating the beta, you're just going to instantaneously capture changes in beta over time. So you're not being asked to estimate beta today and then hold it constant for the next 5 years, which is what a lot of utility regulators do when they do in their rate process. You're actually calculating beta every year, and it's not just for individual railroads. You calculate this on a portfolio basis, so you have more observations, and your estimate is therefore more precise. And the VisiCheck, and I almost exhaust my knowledge of it by saying it, is the reason it's a little more precise is it doesn't take this arbitrary 1/3, 2/3 number. It actually says it tries to determine how much precision is your beta estimate, what's your confidence interval. The more imprecise your beta estimate is, the more it will adjust it down towards 1. But the tighter your estimate of beta actually is, the less you'll leave it alone, because the model is, we think it's predicting the beta most accurately. So at the end of the day, because you're using a portfolio and you're estimating beta every year, AR Smiths, there is no reason to be introducing this complexity. And I'll end on one last note. They cite a lot of survey literature, and they say, well, the surveys show that everybody uses beta, a Bloom adjustment. That's actually not what their surveys showed. If you look at our reply at 28, we noted that the surveys say that 50% of those who responded use unadjusted betas. So it's not like it's the predominant approach to use. Half use it, half don't. We think you're on solid ground sticking with the actual estimate of betas.
What about the recommendation to go to the 50 years, not back to 1926? Maybe I missed it, but I don't think in your testimony you mentioned that this morning.
No, but I'm happy to address that. I believe you should use data as far back as you have reliable data. That's the best estimate. And the reason for that is that if you choose some period, you are inherently going to have to make a decision on a cutoff. Is it 50 years? Is it 40 years? Is it 60 years? I would also like to point out that if you, for example, were to say, okay, so the first period, the 20s and 30s were a little bit unreliable, as was World War II, and you go to, say, 1947, which is right after World War II, and say, let's use from 1947 to today, you would come up with an estimate of 6.8%, very close to what we currently have. If you chose to go in the different direction, which is what a publication by Credit Suisse or the Professor Stimson, Marston, Staunton do, they go back to 1900, you come up with an estimate that's 6.75. for the U.S. So you can extend it a little bit in either direction, and you are very close to what we currently have. So I would not recommend that you choose 50 years or some other. I would recommend to choose some specific date where you say, well, I believe it's as far back as we have reliable data. I believe after World War II. But I think that's what the criteria should be based on. And there's also the simple thing that a friend of mine or colleague, Professor Myers, used to say, well, history tends to repeat itself. So whatever historic information we have is useful.
And then a final question, is this a correct assumption on my part? I thought based on something you said that you've done some work before the Canadian regulators?
I've done quite a bit of work before the Canadian regulators. I have prepared reports for the Canadian Transportation Agency. That was primarily a survey of what methods are used around the globe and a description of what is the pros and cons of each of these methods. I prepared also a report for the British Columbia Utilities Commission, which, by the way, decided to use 50% CAPM, 50% discounted cash flow in its decision. And again, it was partly a description of what methodologies is being used and partly a description of what are pros and cons of the methodologies. I did not, and my co-authors did not recommend a specific cost of equity in those reports.
One of the things I'm wondering is, and maybe there isn't an analog in the way the Canadians regulate railroads, but on this issue of for revenue adequacy, whether or not we're using actual revenues, what the heck is the term that we've been debating back and forth? Replacement cost. Is there an analog in the Canadian approach?
The Canadian regulator does not use replacement cost. I don't think I can speak to whether they do anything of analog. I have not studied that issue, so I'm afraid I'll say something that's inaccurate.
Okay. Thank you.
That's it. Thank you very much. Okay, we're going to take a half-hour break, so we'll be back here in around 12:40 for lunch. Thank you.